Hello and welcome to today's video. In this video, we'll discuss about 5 investment blunders during a market crisis. Mistake number 1, the moment. Mistake number 2, Mr. M is wrong. Mistake number 3, it's different. Number 4, the unrealized loss. Number 5, the buy and the sell price. Stay tuned, we'll discuss all of these and a possible solution for them all in this video. Now, when we make a mistake in our real world, in anywhere, we tend to put the blame onto others. It's a very common tendency to shift the blame onto others. This is an incorrect approach of not accepting the mistakes that you've made. But I understand it depends on your personal choice, and it's almost always a poor financial advice. So let's see the first mistake, waiting for the right moment. So it's very, very common to keep cash at hand and wait for the right moment, wait for the market to come down to bottom itself. And then you would probably plunge in to buy something for yourself. What happens in doing so? Sensex has gone up by more than 100% since 2020 after the pandemic. And many who thought that pandemic was the ultimate call, nothing can be as bad as this, are still waiting with cash at hand. Is it worth it? See, it's recommended that instead of waiting, it's always recommended that you should build a solid structure. Expose yourself structured around a well-defined theme. There are many theme-based investing available. Look at them. Look at them and invest instead of keeping cash at hand. Of course, do not put everything that you have at hand, but do keep something, a little amount, and try and equalize, or maybe try and invest in equal intervals to capitalize on the dollar cost averaging, or maybe to capitalize on the down markets or the up markets. Now, I have 2 videos on this. One is on the wealth building and the other is how money grows on trees. If you see those 2 videos, it's there in the playlist and the link in the description below. You would understand how we discussed when wealth is made during crisis, how it's made during crisis, and what you should be doing, how should be your financial, or how you should plan your portfolio, how you should plan your budgets, how you should plan your budget to meet these requirements, these crisis times. Have something a little bit saved for such scenarios and then start investing the rest. Do not keep money in your savings accounts or underneath your pillow or in your locker or whatever it is. You will continue to keep waiting for the right moment. It will never come. You will continue to wait and you will miss the train. Mistake number 2, the market is wrong. Mr. M is wrong. No, the market is never wrong. The market is never wrong. It's we as individuals, we are wrong. In technical analysis, when we'll go through technical analysis, we'll try and understand this. There is an assumption which is very, very much prevalent in the market. And the assumption is the market discounts all the available information into its price and presents it to you. Which means all known and unknown information available in the public domain is already discounted for in the price of the stock that you're looking at. Which means all known and unknown information that is available in the market has been accounted for in the stock price that you're looking at. So tomorrow, if you feel you've got an information which no one else has got, it's an insider information, it's an information which is not public, it is not found everywhere in the market, it's you who got it, it's not known to many, probably you are being set up for this. Probably this information is fake and someone might have just cooked up a news to deliver it to you deliberately. He or she might have a plan to misguide you in some way or the other. And that's why this information was delivered to you. Or this information was already there in the market. Probably you happen to be the first amongst your friends, your relatives, or your colleagues to get to know about this. So if the price is available in the market, and if this is real news, if it's not a fake news, chances are the consequences of that news affecting the stock price has already happened. The stock has already discounted its price based on the news that has happened in the market. And the current price that you see for the stock has already accounted for the impact that this news has brought for the company. So the rule is never challenge the market trend, because what's happening now may not be relevant to you. You may not understand what's happening now. There are numerous scenarios where after a couple of months, maybe 6 months, you tend to get a notion, you tend to understand why the market is where it is now. You may not get to know at the very right moment, but probably in later future you would understand, okay, fine, this is the reason why the market was where it was at that point of time. So follow the market and adjust yourself as and when the market trend changes. Do not challenge the market. Number 3, this time it's different. No, it's not different this time. It's never different. What we tend to do is we try and link a situation to a market movement rather than understanding why the market has moved. We tend to link a particular situation and say, okay, this is the reason why the market has moved. We tend to link something to a market movement rather than understand why the market has moved in its first place. We tend to predict the seriousness of an event with the market movement. Let me give a small example. In 2020, when the pandemic hit, we saw something which the market has never ever experienced before. No one has seen this before. Like, there might have been examples earlier, but at a scale as big as this, we probably have not experienced it. May not be our fathers, grandfathers, no one has probably seen something as big as this, as big a distraction as this. A total lockdown, a complete closure of businesses, a complete halt on the economic activity across the world, massive losses to business for months and months, massive destruction worldwide. In spite of all these hard times, we see the bear market is at its shortest compared to all other crashes that we can recall earlier. Look at 1992, the scam. Look at the 2000 tech bubble burst, the 2008 financial crisis. The bear market during these phases lasted for months. And look at Corona, look at the pandemic. Look at pandemic, the bear market lasted for just a couple of months. That's it. So you see what I'm trying to explain is, the context is different, not the market situation. So what are the reasons? And what do we suggest on this? The reason is, what doesn't change is our behavior to a given situation. Our reaction to a given situation. It doesn't change. This is always based on greed and fear. Possibly 1992, 2000, 2008 was all about greed. Possibly 2020 was all about fear. But every time it bodes well with the continuation of the bull market. And always it ends in an euphoria. Mistake number 4, an unrealized loss is not a loss. See, this statement is true to some extent, but it's not 100% true. It's not true because if you're holding on to a security which does not have a potential to bounce back, you're holding on to a potential loss which is as good as a realistic loss in your portfolio. You might say, okay, fine, I did not sell it off, and so I did not realize the loss. But this security that you're holding on to does not have a potential to bounce back. It does not give you any signal or any indication that it's going to go up in future. It's as good as a realistic loss in your portfolio. Avoiding losses by keeping a stock which does not have a future in your portfolio is the worst investing decision of all times. This is my personal perception. We'll try and understand this when we'll see behavioral investing in our future videos. We'll try and understand why this happens and how we can come out of this. So, holding on to a stock which goes nowhere eventually gives you nothing. So in other words, an unrealized loss is still a loss in your portfolio. So how do you recover these losses that you have already incurred in your portfolio? The best way to recover these previous losses is to know what we currently have in our portfolio, how will they perform, and how much returns they'll generate, and cover up the losses that we have already made in our previous holdings. That's the only possible way we can recover from these losses that we already made. So this is what we suggest. As the crisis changes, the market also changes, and this change reflects in the stocks that you have already invested in. So our recommendation is quickly sell off the losers, buy the potential winners, which shows a strong signal of movement upwards towards the upward direction, and stick to it. Be quick in selling the losers and buying the structural winners. Don't keep too much cash at hand. Mistake number 5, buy low and sell high. We all love to see the graphs of securities that shows us the lowest points, the highest points, and it's very easy to determine, okay, fine, if we enter at this level and we sell at this level, this is the profit that we can make. But in reality, we get to know the low points and the high points when they have already touched and moved out. We have already missed out those points. It's only then those get plotted over a graph, and then we get to see, okay, this was the lowest point and this was the highest point. It's never easy to predict before they have actually happened in the real-time market, in the real market scenario. In bull market, we tend to search for securities which are trading at a very low price levels. We tend to believe, okay, fine, this stock is trading at a very, very low level. Let's buy this. The market is high, everything is going well. This stock is at a very low level. Let's buy this. This is the biggest mistake that we do if we only judge a stock based on the price which is trading at a very low level during a bull run in the market. During a bull market, if a stock is trading at a lower valuations, there is a reason why the stock is trading at a lower valuations when everything else, every other company is at its peak. There is a reason why this company is not performing, which makes it more important to avoid this purchase. The reason that makes it more obvious to avoid the stock. But what we do is, instead we go out and purchase it at a very, very low level. This happens if we strictly base our decisions based on stock price movements and not by their stock valuations. And just guess, somehow, if you have really approached a strong valuation, if you have really done a thorough research on the company that you want to buy, and it's really actually trading at a very low level, this is now sprinkling salt on your wound. You're getting a real good stock at a very cheap level, and you tend to wait further in anticipation that the stock is going to come down, and then when it's at its lowest low, you're going to make a trade and you're going to purchase a whole lot of it for yourself. The wait doesn't get over. You keep on waiting, and you do not buy it at all. We suggest buy stock at any valuation. If it's a good, fundamentally good, strong stock, buy it at any valuation and sell it when there is a profit. If it's the right stock with the right investment theme, it doesn't matter if you're buying it high or if you're buying it low, or at any point or at any valuation that is available in the market. It doesn't matter. Market shocks are challenging. Don't make it worse by taking these kind of decisions. Have a nice day. Stay tuned. Like and subscribe this channel. We'll bring you more about stock market and investing, all for you. Till then, SG signing off. Goodbye.